Well, first of all, I do want to thank Philip Futures and Chris and Stefan Ulrich from my Singapore office, who has been very supportive. And I'd like to welcome and thank everyone for dialing in today. It's morning in New York, and it's totally a beautiful day. And I know we have people from all over the world, so thank you for that. This is the first of 3 webinars that I'm doing with Philip Futures, and it's to cover the many things that are going on in the gold market and some trading opportunities. There is just so much to cover. It's such an exciting subject. Today we're going to talk about the NYSE Liffe US mini precious gold contract. We're also going to talk about the fundamentals in the market. We're going to cover briefly the question I actually get asked the most. As I work for a U.S. futures exchange that's owned by the New York Stock Exchange, hey, Jennifer, what's the difference between a mini gold future and an ETF? Hands down, you know, a very popular question, and I put it to paper, and we're going to cover that today. The next 2 webinars later in the month, we're going to talk about ratio trading. Have you thought about trading the gold price divided by the silver price? Have you looked at other commodities in terms of the price of gold? And our last webinar that we'll do on July 24th will be gold futures arbitrage opportunities. We have MCX, we have TOCOM, and we have American exchanges. What are some opportunities there? So very excited to do all those. But today what we're going to talk about is I'm going to tell you a little bit about NYSE Liffe US. We'll talk about the gold futures, the ETFs, and then we're going to get right into and spend most of the time on the price action, the fundamentals, what's going on. Gold's down 25% in the first 6 months of the year. Is this an opportunity for longs to get in? Let's see. And of course, we'll provide our contact information and all kinds of other data to get you going in the market. So NYSE Liffe US is the U.S. futures exchange of NYSE Euronext. We were launched in September of 2008. We are regulated by the CFTC. We do have 3 asset classes. Of course, the mini metals, our mini gold and mini silver futures dominate that. In terms of equity offerings, we have the MSCI emerging markets and EFA products, as well as many other MSCI-based futures. That's a very exciting complex. And where we have made great progress is in the interest rate sector with some exciting original products that can help traders in the post-LIBOR, or not the post-LIBOR, but since the LIBOR crisis began. So exciting products in the interest rate side as well. So let's move on to mini gold futures so you can have a sense of our offering here. The code on Philip Futures would be YG. The contract size is 33.2 ounces. If you have a position of 1 lot and you've made or lost 1 tick, you've made or lost $3.32. The contracts are physically deliverable in the United States, in New York, and in Delaware. So right now, to give you a sense of the contract size, the notional value using $1,250, a little bit lower than today's price, but just by a couple of dollars. So it's worth about $41,500 notionally. The initial margin is $3,166. The initial margin as a percentage of notional right now is 7.6%. Actually, that is a little bit high on a historical basis. And why is that? As those of you that have been trading futures for a while know, initial margin is directly influenced by volatility. and certainly gold has had some volatile days. We'll talk about the couple of days and the one big day in April. Massive move. So if volatility continues to decrease, then we should see that initial margin as a percentage of notional drop. And that's a good guideline anyway for somebody looking at trading any futures. It'll be a tip-off to volatility, and it'll give you a sense of your buying power. The volume and open interest, here is this chart. You can see that April and May of this year were very busy months. We had record volume, of course, when it was the market was coming off very sharply, about $34,000 on April, 34,000 contracts on April 15th, and the average daily volume right now is 5,400 contracts. The market, we're fully electronic at NYSE Liffe US. There's no trading floor. It's fully transparent. Everybody gets to see the orders, you know, the order book, as it were. And we do use a first in, first out trade matching algorithm. Below here, I do have a link to a sort of an overview that we provide that's about 6 pages long that describes the market. I'm certainly going to do all that here, but that link is for your review for later if you can find it convenient. For NYSE Liffe US, the message here is if you want to trade a US dollar mini, our mini gold is by far the most liquid. We find that our investors and traders like the fact that it is smaller than the standard 100-ounce contract because it allows them to do some cost averaging. It allows them to get in and participate in the gold market at a lower level, at a proportionally less risk level. And of course, trading futures gives you the exposure to the attributes of the gold market, which, as we well know, portfolio diversification, you know, it's a form of savings, of course, and provides various hedges. As I mentioned in my introduction, comparing exchange-traded gold products is one of the questions I get asked frequently. So clearly, mini gold is a future. The ETF, let's say GLD, it's a very popular one in the United States, of course. That's an equity. So our futures market is regulated by the CFTC. Equity markets are regulated by the Security and Exchange Commission. So it's a different regime. You do need a futures account to trade futures. You need an equity account to trade equities. The simplicity of the ETF is that equity traders who just want exposure to the price of gold can participate in that by purchasing the GLD. Exposure with the $3,166, which is the initial margin that we mentioned. Of course, that would get you positioned in a 1 mini gold contract. In the ETF, that would get you about 5 ounces worth of the ETF versus 33.2 ounces of the mini gold future. If the gold market moved $10, you would make or lose $332 on mini gold. You'd make or lose $50 on the ETF. Access to physical. Yes, the precious metals futures are physically backed. The ETF, when you buy the ETF, you actually buy into a fund, and of course the fund owns the gold. There's no management fee with futures, and ETFs typically do provide, do collect a management fee over the course of the year, which is broken down daily, and at the moment that's 40 basis points per annum in the mini gold, in the GLD. Lots of other considerations. I just wanted to provide the broad brush comparison, you know, in our table here. but the ability to go short, trading hours, liquidity, tax treatment, total transaction fees, you can certainly line these up and have a better sense of which product would be more useful, or perhaps a combination of them. Now I'd like to sort of get to the meat of the presentation, and we're going to talk about what's happened so far this year. We're not going to spend a lot of time in the past, but I think here is a useful chart. We have the price of gold in various currencies that are important throughout the world, and you can see clearly we've had a very sharp rally over the past decade plus in both Indian terms, Chinese terms, European terms, and of course US dollar terms. However, more recently in 2013, there's been some significant changes. There's been changes in US interest rates and expectations of them going forward, and that has had a big impact. Now here we have the mini gold price versus the US dollar index, just to give you a sense of the negative correlation with the US dollar. And as you can see, we have the gold price in white, and we have the US dollar index in orange. And really what you see here is this is the beginning of 2013. We can see that the dollar has had bouts of strength. And what you can see here, though, is there's been, even when there was weakness, significant weakness here, gold was only able to rally a little bit. And so the next time that the dollar took off, gold really reacted negatively. So, you know, sort of that's one hint. If you can't rally, you know, when something is positive, you have to take a closer look. This is really, you know, a 5-year picture of gold versus the dollar. It's important to take a look at mini gold prices, again in the white, here versus the S&P index, just as a representation of equities. And clearly you can see that these are not correlated, which has been obviously one of gold's incredibly useful roles in terms of portfolio diversification. But certainly you can see that in the first half of 2013, with 2013 being the end here, the very strong equities in combination with that stronger dollar towards the end definitely had an impact on the gold price, as we see gold prices move significantly lower in the first half of this year. Here we have mini gold prices versus the U.S. money supply, and at this point I'd like to take a step back. Right, we can see we've had a significant sell-off recently, but the perspective here is to give you the big picture. So one of the key reasons to our significant rally in mini gold prices. Gold prices here are in the gold color, and the U.S. money supply, or M1, is in white. And you can see the very, very dramatic and steady increase of the supply of money, of U.S. dollars, starting post-Lehman crisis in late 2008, when Ben Bernanke decided that quantitative easing was the way forward to help the U.S. economy. And what this did in a big way, of course, was to help gold prices. Now, starting in October 2012, gold prices, so sort of about here, Gold prices were declining, yet M1, because we are still buying $85 billion of treasuries and mortgage treasuries every month, the Federal Reserve is, M1 kept expanding. So here is where we have a very significant break with the trend. We've had back and forth here as well, and this is very clearly defined though in 2013 and has to be considered, a very interesting observation. Expansion of the money supply continued, gold prices stopped reacting. Why did gold prices stop reacting? Here we have a chart of the 10-year Treasury yield minus the 2-year Treasury yield. And in the United States, that is a very good look at the interest rate market and what the market is thinking in terms of predictions for inflation. So what we have here is in about July of 2012, we had our first bottom, right? And at the end of the year, at the end of 2012, we had another bottom just right here. May of 2013, we had our triple bottom. And what we saw here was that the difference between the 10-year and the 2-year grew positive by 62% in less than 2 months. So we went from about the difference between the 10-year and the 2-year being about 1.4 to being 2.27. This is the market saying we expect inflation. So therefore, that is why even though money supply expansion is continuing, that's one reason why gold prices stopped reacting to that. And we've had some very strong sell-offs in gold in the second quarter of this year. Well, hold on a minute. We have the Federal Reserve making comments at the end of December, or at the end of the year on December 11th, talking about U.S. unemployment. Federal Reserve announces it will continue to keep interest rates low as long as the unemployment rate remains above 6.5%. I don't know if you know, but currently the U.S. unemployment rate is 7.6% and certainly has not been below 6.5% since September 2008, which is of course about when the dramatic quantitative easing expansion of the M1 supply began. The target rate of 6.5% is the green line. So I just wanted to point out that if the Federal Reserve is going to stand by this statement, we do have a significant way to go to get to their target. So let's see, let's just keep that in your mind. Who's been the biggest seller? Well, we understand that it's the ETF, the exchange traded funds, that have been the biggest liquidators in the gold market. Here we have a picture of basically all the exchange traded gold funds, and the assets under management got as high as 2,641 tons just in December, so right, just 6-7 months ago. But since then, there's been a very steady decline with some very dramatic movements on even in certain days. GLD remains the largest by far with 947 tons. Of course, GLD is listed on U.S. equity markets. I don't know if everybody knows who that picture is there. That's John Paulson, who has been an incredibly successful investor in many markets, particularly the credit markets, really made his name. We're talking billions and billions of dollars. He has a very small gold fund, which has GLD as one of its components. And I mean small by comparison to his other billions of dollars worth of funds. And you know, of course, he's losing money in his gold fund, so he regularly gets trampled in the U.S. press in the first half of this year. So we're down from 2,600 odd tons to a bit over 2,000 tons, so that's a significant drop. And Barclays pointed out just last week that a significant number of owners of GLD are underwater in terms of you know, where they got into the product, so something to keep in mind. The discussion about the ETF holders put forth by the World Gold Council is the people, the traders who have liquidated GLD, which is of course treated as an equity, are the types of traders who are very sensitive to other markets, to big macro trends, to the fact that equities are taking off, to the fact that the dollar has gotten very strong, to the fact that interest rates, you know, as we saw above, interest rates are rising, inflation expectations are rising, prospects of global growth. Many traders are, you know, global hedge funds have become more optimistic about global growth, and they're exiting this safe haven place where they had parked their dollars. So that's sort of the perspective I wanted to provide on GLD and why that's been an important factor. In terms of price action, here we are. This is the price of gold in 2013, pretty much a bear market. The idea is here on number one, as early as January, the Fed indicated it could end quantitative easing sooner than expected. You know, and equities were rallying. They liked the idea of global growth. However, throughout this half of the year, central banks were buying. Emerging central banks were key. We'll cover that in a couple of minutes. Korea, for example, was the significant buyer, 20 tons. While in the first quarter, the ETFs were losing. There was liquidation of the assets under management in the ETFs. Then again, in April 10th, the Fed makes noises on exiting quantitative easing earlier than expected. And you may remember the Cyprus idea of perhaps selling their reserves. That was perceived as a huge negative. Chinese growth, when we look at the demand statistics in a couple of minutes, you'll see why. Very concerned, you know, over a lot of markets, obviously, of how Chinese growth goes. That caused a significant sell-off. April 12th, gold prices are down $64. April 15th, that Monday, $140 further down, a $228 range in 2 days. ETFs in April lose 176 tons. ETFs in May lose 125 tons. June, 101 tons. So what the message here is clearly that the investment part of the market, of the demand market, has been the driver thus far in price action. Now that we talked about the price action and, you know, the various participants, various contributors in terms of the rates, equities, value of the dollar, let's take a look at the fundamentals, right? World Gold Council provided these statistics, and you can see here this gray line is supply. So supply is steady, dipping down just a little bit. But as I started just a minute ago to say, the 2013 estimate for jewelry is up a reflection of stronger economic um, situation for many people. We can see here also that the investments, which is this dark green here, is down significantly, right, compared to 2012, compared to 2011. So, and that is really the point I was trying to drive home. Here, that's telling. I mean, that's what's been affecting the price. We've also seen central bank purchasing over the past 3 years. To me, that's a very exciting development. But pre-2010, central banks were traditionally liquidators. They were traditionally getting out of gold. But now the idea is to diversify their dollar assets, their euro assets. And we'll see in a minute or two just what central banks are buying. In terms of consumption, right? India, China, USA, Germany, Turkey, Switzerland, the largest consumers. No surprise there. We are, we closely watch what is happening in India in the gold market, closely watch what China's doing. India, lots of concerns about the taxes that have come into effect. So far, they have not. In fact, there's been anticipatory buying. As you know, the Indian government is very concerned about their current account deficit, and after oil, gold is the next reason for that current account deficit. And so the government has actually said, hey, please stop buying gold. It's been fascinating to watch. Let's break this down, sort of big picture. This one is also from the World Gold Council as well as Thomson Reuters GFMS. And here it's very clear. The dark purple, here's ETFs. They've gone negative. And the amazing thing is, typically when ETF volume is positive, demand is positive, physical demand is positive. Now we're coming to a time where that's a diversion, and that is the huge factor that people are absolutely fascinated about in the market this year. Investors are thinking one thing, physical buyers are thinking quite another thing. We can see here again that jewelry is very important, total bar and coins are very important. Demand by region. No surprise, China and India, very important. This is data for the first quarter of 2013 right here, and you can see the very big growth compared to even the fourth quarter of 2012. I'm sorry, the first quarter of 2012. Look at this big jump. India, China. This is the 5-year average all the way over here on the right. So you can see significantly ahead of pace of the 5-year quarterly average for jewelry. It's a very positive sign there. Global bar and coins is the second chart, and here it is for Q1 2013. Again, really fascinating. India, China, the big factors, and look how it is. Look how strong it is compared to the 5-year quarterly average. 34% above the 5-year average. A quick look at the official sector. Central banks, top holders, United States, Germany, IMF, Italy, France. China's number 6. If we go down a little further, we took the liberty of looking at Asian, East Asian nations. India, number 11. Taiwan, 14. Philippines, Singapore, Korea, Indonesia, Malaysia, Sri Lanka, Bangladesh, Laos, and Hong Kong. The Asian countries, gold is very important to the central banks, and the trend that we've seen in the first half of this year and even last year as well, it's the emerging markets that are currently buying. Russia, Ukraine, Kazakhstan, Korea, Azerbaijan, Indonesia, all looking to add to their central bank reserves. The top gold producing countries: China, Australia, the US, South Africa, Peru, Canada, Indonesia. These are our producers. This is where we get the gold from. China, a very significant part of the gold market, both on the buy side and the sell side. This is an amazing chart to me, to somebody who's been in the gold market for a long time. The cost of production, wow, has really gone up dramatically. If you look at it, we were looking all in cash costs, below $400 in 2005. I can remember close to half that, even 5 years before that for some companies. Now we're at $1,211. And as you know, we actually were below $1,211, and we traded there quite a bit. So, and this is just the average. There are many producers that have mines that are operating at costs that are higher than where the current gold price is. And over time, those mines, if the price does not move back higher, of course, over time, management will make the decision, likely make the decision to close uneconomic mines. Other mines and other firms might postpone development of mines that they've explored. For example, very recently, Barrick, who's the #1 gold miner in the world, recently decided not to continue or not to develop a mine in South America. And they'll say, hey, we'll look at it again in 2016. The highest cost producers, those are going to hurt the most: South Africa, Australia. Most efficient are in Latin America and North America. So I hope I gave you a sense of the issues, headwinds in the gold market right now. That was my objective. My objective also was to introduce you to NYSE Liffe US Mini Gold, give you a sense of the differences between the ETF and our Mini Gold futures. Hopefully I provided some food for thought about where prices might go. Clearly, as an exchange employee, I'm different from an economist that makes a living on making predictions. But certainly, it's very fair to say the investor has been the driver of the price thus far this year. U.S. interest rates have been key in those decisions. Optimism about growth in the U.S. Has also played in. On the other hand, we certainly have to remember the cost of production is not good for many mines around the world. I mean, that could be its own webinar. Physical demand, extremely strong. We still do have weakness in many developed economies. Sovereign debt crisis is still with us. Central banks have turned buyers. So that is really, Chris, what I wanted to tell Phillip Futures clients and prospective clients today, and also leave them with the thought that if they want to try futures, US dollar-based, our Mini Gold future is an excellent vehicle to participate in the gold price with. Mm-hmm. Here are our contacts. As I mentioned, Stefan Ulrich is here or there in our Singapore office, and very knowledgeable about the product as well. And in conclusion, Chris, I'd like to thank you for this chance to present, and please let me know if there are any questions.